Today I thought we would go over a practice test since we have tests are coming up very shortly. So let's do this now. Um, so this is an example of a test that was given a few years ago. It basically gives you ideas. We'll cover debits and credits after the test. And we'll change things up a little bit than we normally it's asking us to do in the test um, because journalizing will address after the next test. So um, let's go over this now. So I made, to save us a little time, I drew out our assets liabilities. The first thing I did was down here. I drew our L crew just as a quick reference, and then I started drawing out a blank T-charts. So if you want to take a second now, grab a piece of paper, pause the video, and we could write along as we go. All right, so pause the video now and then come back. Perfect. So now you've all copied this onto a piece of paper and we are good to go. Now the question number one asks us to journalize. We're not going to do that. We're going to put them right onto T-charts. We'll talk about journalizing after the next test. All right, so you own and operate a golf course, and these are the transactions that take place on January 2018. All right, so let's go through this. So you invested, and what is keyword when we say invested, right? We put money into, right, or used the cash. So into a company as well as $18 worth of golf equipment. All right, so if you remember our steps, our first thing we need to do is look at which account. So there's two transactions that are actually happening here on January 1st. The first is invested, and then the purchase of the golf equipment. So first, what are the two accounts when you are investing? If you're investing, you're getting part owner, so you own capital. And the other account would be asset because it's invested into the company. So let's look at our equity. So our equity went up $25,000. And our cash, we'll draw a T-chart for our cash. Right, cash or bank. Did it go up or it went down for the company? It went up. Obviously, you got invested. So now the company has $25,000, and you own $25,000 in capital, right? So left equals right. So we're good. However, also on January 1st, we purchased $18,000 worth of golfing equipment. Holy cow! So what are the two accounts? The first thing we're looking at. Well, one is cash. We know because we paid for it, right? So we went to the bank. So the cash is one. And then we bought golfing equipment. What is golfing equipment? Is it an asset? Absolutely. So it would fall under, so in this case, we're going to just put under equipment. Oops, equipment. Okay. All right. So cash, $18,000. So let's fill it out, $18,000. Right, because we had to go for the bank and pay for it. And did our equipment go up? Yes, because now we bought those golf carts, right? So that is $18,000. And we're good. January 1st, excellent. Okay, next transaction. On January 4th, we received a bill for $1,200 that we will pay later in the month. Okay, so is that a bad thing or a good thing? We have to pay something. It's a hint. Yes, it's a bad thing. We don't want to pay bills. So that is a liability. We talked about the two that get mixed up all the time, and we'll address that in a minute. So to pay, right, it's accounts payable, so AP. One account. And what's the other account? What is this if you receive a bill? Right? Is it a revenue? No. Is it an expense? Absolutely. So it was an advertising bill. So let's draw a chart over here. Advertising expense. Okay. All right. So now let's fill it out. So did the accounts payable go up or did it go down? It went up, right? Because it's a plus sign. We're going to owe it later. How much was it? $1,200. And did our advertising go down or it went up? It's an expense, so it went up. So it went on the left-hand side, right? See the value of putting the plus and minuses and understanding whether something goes up or if it goes down, right? Okay. So that was January 4th. So January 3rd, we completed a training job worth $4,000 and your customer will pay later. So they'll pay us later. So that's a good thing, right? So what are the two accounts? Well, if we did a job, we're going to receive money, but didn't get received because they're going to pay later, right? So we're going to receive money later. So what's the other one that gets mixed up with the accounts payable? Accounts receivable, right? And what's the other account that gets used? We know it has to be one of these. Revenue? Yeah, it's revenue, right? We're going to generate revenue from it. So, chart. Service revenue. Excellent. So those are your two accounts. So how much did we get? Job worth $4,000. We'll pay later. So that's an asset. So it's going to up or down. Well, it went up. Right? Our accounts receivable went up. So it's increase. So it goes on the left. And our revenue, did it go up or did it go down? Well, it went up again. So plus is on the right. So it would be over on the right hand side. And right equals left or left equals right, however you look at it, and we balance. So we're good. All right, so what happened on January 7th? January 7th, paid $1,000 cash towards money owing from a transaction in transaction B on January 4th. So we paid for some of the bills. All right, so what are the two accounts? Well, if we paid cash, we know that's one, right? So cash is going to be one towards an account owing from transaction B, and transaction B was the bill. So our accounts payable will no longer, right? We won't owe as much money. So those are the two accounts. So how much did we pay towards the bill? $1,000, right? So we took money out of the bank. We've literally walked over, got some money out, $1,000, and we put it towards the bill, right? Did it go up or did it go down? Well, it went down because we reduced this amount owing, right? So it went down $1,000. Cool. All right. Anything else? Nope. Perfect. So then what happened? So then on January 15th, received the full amount from the amount owing from the customer on transaction C, which was that job that we did for $4,000, right? So we know that if it has something to do with this, it's going to affect our accounts receivable. And what did we receive? The full amount owing. So they paid us. So they paid in cash. So those are the two accounts. So cash and accounts receivable. So we received this. So did our accounts receivable go up or did it go down? It went down, right? So $4,000. And why does it go on the right hand side? Because it's minus. It went down, right? Or decreased. And if they paid the $4,000, they paid it in cash. So we finally got to put some cash in the bank. So that would go there. All right. So we're all done. Anything else? Nope. So the last thing that we need to do, we just need to total these, just like when I showed you before. So we need to double underline. So let's just quickly do a quick math. So if anyone can do the quick math, you got 29,000 minus 9,000. I got 29 minus 19,000. So that should give us $10,000. And we have $10,000. We're not in the hole, so we're going to put it on the left-hand side, right? Because it's a plus, and we're going to double underline it. Our equipment is still 18,000. There's no others, so that's good. We need to do this for all our charts. Accounts receivable is 0. So we don't need, so we can 0. Accounts payable. Well, we paid $1,000, remember? So we still owe $200. So if we did the math, right? Plus, minus, tells you what you're subtracting. Capital, it didn't change. There was no withdrawal, so we don't need that. Service revenue, there was no more, so we double underline. And expenses, there was only the $1,200 expense. All right, perfect. So let's move on to the next one. So scrolling down, there's some blank T-charts. And we'll move right into these. So again, we're not going to journalize. We're going to just use T-charts and go through them. So you still own the golf course, and we're going to journalize the following transactions. All right. So on January 5th, what happened? Completed a training job for a client worth $2,000. The client paid cash. Woo! All right. So what are the two accounts? Well, cash is always a good hint, right? And we completed a job worth $2,000. So when we completed something, that would be revenue, right? Service revenue. So let's draw those accounts now. So cash. And revenue. Oh, sorry. Service revenue. Right? We have to make sure we label it correctly. Because if we not, service revenue. All right. $2,000, so they paid cash. So those are the two accounts. Let's fill it out. So cash went up because they paid us. And our service revenue went up because we made some money, and that goes on the right-hand side, right? Again, the benefit of making sure that we put the little pluses and minuses to help us not make the mistakes. And we also get a little, clarifies it a little bit easier. We don't get confused. All right, anything else happen on January 5th? Nope. All right, let's look at January 10th. You withdrew $500 cash from the business for personal use. So that's a pretty easy one, cash being one. And what else? Withdrawals, right? Personal, right? Withdrew, it's always a good thing. Withdrawal, so it goes into there. You use it for personal use. So first of all, what happened? Our cash went down $500. And the withdrawal went up $500, right? Because you can use it for something else. You maybe bought a new bike, which is always a good thing. So, and does left equal right? It does. So we're good. So paid a telephone bill worth $200. Perfect. So we paid it, right? Not paid later, so we're paid for it. So what are the two accounts? Well, we paid for something. We had to go get the cash. So cash will be one. And what's the other account? Is it a liability? No, because we actually paid for it, right? We're not paying it later, so we paid for it. So it would be an expense, right? A telephone bill. So let's draw that account. So telephone expense. And let's follow the ball, bouncing ball. So paid a telephone bill worth $200. So we went to the bank, we took out $200. So our assets went down, our cash went down, and our expenses went up. So it goes on the left-hand side, $200. Perfect. And left equals right. So we're all good. Received $3,000 for a catering job that will be completed next month. Okay. So received, so that's one account when we say received $300 cash. So we know cash is going to be, and the other one is for a job that will be completed next month. So have we earned the revenue yet? No, we got paid the cash, right? So do you remember what unearned revenue is? It's a liability one, right? Another big one, right? Because think about it, if someone wanted to, they paid us, we haven't done the job, and we decide not to do the job, they can go to court, get the money back because we haven't done the job. So that would be the other account. So liability. So this is the one that always gets mixed up because everyone thinks, because it has the word revenue in it, that it should go under revenue, but we haven't earned it yet, so it's a liability. All right, so another one kind of not to forget. So how much did they pay us? $3,000. So cash went up. And it goes on the left-hand side because the increase is on the left. And on a liability, did it increase our liability? Absolutely. So the plus or the increase is on the right-hand side. So we still need to do the job. So it's a liability. Excellent. All right, what happened? So in January 22nd, paid for 12 months worth of rent for $1,200. So paid 12 months worth. So kind of paid for it in advance, right? So what is that? What are the two accounts? So we paid, right? So cash is going to be one, right? And $1,200, right? What does that fall under, right? So it's an asset because we haven't used it, right? It's at the beginning of the month. Remember that? Another one would be insurance. So we prepaid rent, right? Because remember, we haven't used it up yet, so it's not an expense. Okay, we just paid for it. It's right at the beginning of the month. So how much did we pay for the 12 months rent? So it's $1,200. So did it go up or did it go down? So our prepaid rent, or if you want to follow, we took the cash out. So $1,200 we took out, and then we moved it over here because we haven't used it yet, right? So technically, if say we haven't moved in, we moved right out again, we could get our $1,200 back because we haven't been there for a month yet or 2 months or whatever, but we paid for 12 months rent, right? Excellent. That's it. So what happened? So on January 31st, recognized, and what's another word that we use for recognized that helps to understand it a little bit clearer, maybe? Used, right? So we used 1 month rent. So after a month rent, we used it up. So if we decide to move out, we could get some money back, but we used up already. So what's now that becomes an expense because we used it up, right? So prepaid rent is one because we know that because it's previously paid. So that's going to be one of the accounts. And then the other account would be rent expense. All right, so let's fill it out. So how much did we use? 1 month's worth. And 1 month, if we look at the previous transaction on 22nd, 12 months of rent was $1,200. So every month, if we do some quick math, we know that each month actually costs us $100. Well, if we only use 1 month, that means one was only $100. So our prepaid rent, we used up $100, and our rent expense went up $100 because it's only been for 1 month. And then left equals right, and we're all good. All right, is there any other transactions? Nope, that's it. So the last thing that we need to do is what? We need to total it up. So if we do the quick math, and I'll quickly do because I already cheated, I did it before, it should be $3,100 total, double underline. Prepay rent is we've used up $100, so we still have $1,100 as an asset total. And it's on the left-hand side, right? Because it's a positive, right? That's why we're keeping it here. That hasn't changed, so we can just double underline that. Withdrawal didn't change. Revenue didn't change. Expense, telephone expense didn't change, and rent expense didn't change. All right, and that's it. All right, let's move on to the next one. Right along. Now we need to generate some financial statements. So we need to generate an income statement, a statement of owner's equity, and a balance sheet. The company's name is KB Sport Camp, and the month ending is December 31st, 2017. Excellent. All right, well, let's start. So what's the first thing we need to do? We need to write the company's name. So it's KB Sport. And then what's next? The name of the statement. And which one do we do first? Income statement. Statement. And then what's next? The date. Absolutely right. So December 31st, 2017. All right. So the other thing that I want to talk about, we haven't touched on it, I don't want to get people confused, is the next two statements, so income statement and statement of owner equity, are always done at the end of the month. So when you put the date in, it needs to say either month ending or you can do month ending, right? Because it's done generally at the end of the month, hence December 31st. When we look at the balance sheet is a specific point in time. But the first two are always month ending. All right. So now that we know all these statements, I just wanted to touch on that. I don't want to get everybody confused. So that's the last little thing that we need to know about financial statements. That the first two, so income statement and statement of owner's equity, must have month ending in front of the date. And the balance sheet is that specific date. So no need to worry. All right. So when we do income statement, do you remember what's the formula for income statement? No cheat sheets. So if you remember, it's revenue minus expenses equals, right, net income if it's a positive, or net loss if it's a negative. All right, so let's do that. Let's start filling that. So revenue. It'd be easier, like on a test, it would give you, as you can see over here, it'd give you the sheets to actually fill it out. But we're freestyling it this way, so we'll have to work through it. So let's look and see what we have. So first thing we're looking at is revenue. Force of revenue. Unearned revenue. Is that revenue? No, it's unearned. That's the one that everyone gets mixed up, right? That is not revenue, right? Does anyone remember what that falls under? It's a liability, right? Absolutely. All right, so let's see. What else? Revenue, expenses, cash, expense, equipment, capital. Oh, service revenue. Service revenue, $21,000. There it is. So we label it service revenue, right? And it's $21,000. Let's see if there's any other revenue. Receivable, expenses, and we know that, right? Because it'll say revenue in it. So there are no others. So that's it for revenue. Minus, according to our formula up here in the top right, expenses. No, we always know there's lots of expenses, right? So let's see if we can find some expenses. Unearned revenue, nope. First one, bank fee expense. So, bank fee, bank expense, and it is $800. All right, let's move along. Cash, no. Accounts payable, no. Expense, we're looking for words that have expense in it. Salary expense, there's one. So salary expense. How much is that? $4,000. So keep in mind, this is important. It makes life easier for math. Keep your numbers aligned. That lessens your chance of making mistakes as we go through. So salary expense, check. What's the next one? Rent expense. We know that's one. rent expense. How much is the rent expense? $2,000. Perfect. Any more? Prepaid insurance. Oh, telephone expense. There's another one. Tele expense. Tele expense. $50. Excellent. Any more expenses? Telephone expense. Travel expense. $500. Not a whole lot of travel going on these days, but travel expense. How much was it? $500. Excellent. Drawings, 3,000. No, there's the last one. Insurance expense. Right, we always know there's generally going to have to be rent expense. Right, those are biggie. Bank expenses, salary. Those are ones that are common, so you should always be looking for those when you're doing an income statement. And your insurance expense in this case was $250. Okay. Any more? That is it. Excellent. So let's total these up. So the total here is 21,000, and the total here is 7,600. All right, that's your total. Are we done? No, because we need to know if it's a net income or a net loss, right? Well, we just quickly look, so we know revenue is a lot more than the expenses. So if you do the math, so it would be a net income because it's positive. And it would be 13,400 if my math is correct, right? And that's what we're looking for, so that's final answer. And we double underline. All right, perfect. Let's move on to the next statement. Report is a statement of owner's equity. So what is the formula for statement of owner's equity? Do you remember? So let's write up here as a little reminder. So opening capital plus capital plus net income minus withdrawal or drawings minus net loss equals ending owner's equity. All right, so let's do the statement of owner's equity. So what's the first thing that we do? Right, write down the name of the company. So KB Sports. And then what's next? Right, the title. We need to always make sure we label what the form is. So statement of owner's equity. And remember what I mentioned in the previous statement, in the income statement, right? So we have to put the date, you're right, but we need to put month ending. December 31st, 2017. All right. All right. So we're good to go, right? All right. So let's just start doing the formula. So opening capital. Is there anything that says starting we're opening capital? No, there's capital only. And remember, so if you don't see something that says started with or opening capital, we assume that it's 0. So we can't find one, so it's 0. What's next? According to the formula, capital. So capital, now we just saw that, and what is it? $10,000. Nice. And net income, well, remember from this again why we have to do it in a certain order. From the income statement, the net income, anyone remember what it was? Net income, and it was $13,400. Perfect. Minus withdrawal or drawings. So withdraw or drawings. Let's see if there are any. Unearned revenue. No, we're looking for something that says withdraw or drawings or something that they took money out for personal use, right? Ah, there we go. Drawings, $3,000. So I'm going to put it over on the right-hand side. I don't want to get them mixed up. What is a positive and negative? And is there any more else? Nope, that's it. So only drawing. And then net loss. So net loss. Now, because there is a net income, can we have a net loss? No, it's one or the other, right? So it's 0. Perfect. So let's total those up. So you should get 23,400, 3,000. You see the benefit of keeping things in line. Therefore, if we're using our formula, right, because this would be a minus now that we know. So ending owner's equity equals $20,400. That's final answer, so we double underline. All right, perfect. So the only other thing we could put on here, we put total. We understand, it's very clear. All right, perfect, done. Last but not least, let's look at the last statement that we need to do, which is the balance sheet. All right, so what is the formula for balance sheet? Assets minus liabilities equals, sorry, it's been a long day, it's not equals. Plus owner's equity, right? All right, so let's move along. So what's the first thing we do? We write the name of the company. And the company is KB Sport. The name of the sheet that we're doing, or financial statement, is the balance sheet. Right? And the date. So remember the balance sheet is the only balance sheet can be taken at any time through the month. So in this case, we do not need to use month ending. So December 17th, 2017. Excellent. So let's do the math. So assets, good way to lay it out. Liabilities, and owner's equity. All right, let's look at the sheet. So what are we looking for? So let's look for assets. Is bank fee? No. Is cash an asset? Yeah, it is. So cash. How much cash do we have? 25,000. 0 to 5. Right. Where are we? Okay. Accounts payable? No. Salary expense? No. Rent expense? No. Equipment? Is equipment an asset? Yeah, it is. Equipment, and it's $11,667. All right. Is there any other assets? Capital service revenue. Is that an asset? Nope. It's revenue. Prepaid insurance. Yes. Prepaid insurance. Remember, it's something that we've banked, hopefully to use in the future. So prepaid insurance is an asset. We haven't used it up, so it's an asset. And it is $600. Excellent. And where are we? Prepaid insurance. Is there anything else? Accounts receivable. Oh, receiving. We know that, right? That's always a good thing. So accounts receivable. That means people owe us $20,000. So yeah, AR is an asset. Accounts receivable, remember, is an asset, and they owe us a lot of money. $20,000. Is there any expense, drawings, expenses? Nope, that's it for assets. Perfect. So now let's look for liabilities. What's the first one that we see here? Ooh, remember I mentioned about this? Unearned revenue. It's a liability. Why is it a liability? Why is it in revenue? Because we haven't done the job yet, right? They've paid us money, but we haven't done the job. So if we decide not to do the job, they could come after us and we'd have to get back the money. So it's a liability. So until we complete that job, it becomes a liability. So unearned revenue, and it is 20,142. Perfect. Is there any others? Accounts, cash, accounts payable. The word pay, we have to pay. Paying sucks, right? That's bad. So that is a liability. And how much do we owe? $16,750, right? Absolutely. Is there any others? Revenue, insurance, receivable. No, receiving is a good thing. Drawings, expense. No, that's it. Perfect. And last but not least is owner's equity. And what was owner's equity on the last one? $20,400, if I remember correctly. Perfect. So let's do some math. So let's add these all up, and you should get 57,000. I cheated or I did the math earlier, so I didn't have to waste your time. 57,292. And our liabilities, we add that up, is 29863. And our owner's equity is what it is. And if we stick it into the formula, we add these two up, and it gives us 57. Right total. Right total over here. So we can make sure. So it goes 57,292. Perfect. So does it fit the format? Yes. So final answer, left equals right. And we're all done. All right,